Welcome to our CFP Exam Prep podcast. Today we're diving deep into Kiddie Tax, a crucial concept that frequently appears on the CFP exam and often trips up test takers. Let's start by breaking down what Kiddie Tax really means. The Kiddie Tax rules were established to prevent parents from shifting their investment income to their children to take advantage of lower tax rates. Under these rules, a child's unearned income above $2,600 is taxed at the parent's marginal tax rate. Understanding who's subject to Kiddie Tax is essential. It applies to children under 19 years old or full-time students under 24 years old who are claimed as dependents on their parents' tax returns. A common exam mistake is forgetting that the age limit extends to 24 for full-time students. Let's walk through the three-tier system for children's unearned income. The first $1,150 of unearned income is tax-free. The next $150 is taxed at the child's tax rate. Any amount above $2,600 triggers the Kiddie Tax and is taxed at the parent's rate. Test takers often miscalculate these thresholds or confuse which rate applies to each tier. Here's a practical example that commonly appears on the exam. Imagine a 20-year-old full-time college student who earned $3,500 in dividend income from inherited stocks. The first $1,150 is tax-free. The next $150 is taxed at the child's rate, typically 10%. The remaining $1,200 is taxed at the parent's marginal rate, let's say 32%. Many candidates make the mistake of applying the parent's rate to the entire amount or forgetting to account for the tax-free portion. Another critical aspect is understanding what qualifies as unearned income. This includes interest, dividends, capital gains, rental income, and trust distributions. A frequent exam error is misclassifying earned income from a summer job as unearned income. The CFP exam often includes questions about exceptions to Kiddie Tax. Remember that if a child is married and files a joint return, Kiddie Tax doesn't apply. Also, if the child provides more than half of their own support through earned income, they're exempt from these rules. Test takers frequently overlook these exceptions when analyzing case studies. When studying for the tax portion of the CFP exam, pay special attention to how Kiddie Tax interacts with other tax concepts. For instance, questions might combine Kiddie Tax with gift tax exclusions or education funding strategies. A common trap is failing to recognize when Kiddie Tax implications affect the overall tax planning strategy. Here's a key tip for the exam. When you see a question involving a dependent child with investment income, immediately check their age and student status first. Then verify if the unearned income exceeds $2,600. This methodical approach will help you avoid rushing to incorrect conclusions. Lastly, always remember that Kiddie Tax calculations require knowing both the child's and parent's tax rates. The exam might provide this information in different parts of the question, so read carefully. Many test takers miss points by using incorrect tax rates or failing to identify all relevant information provided in the question. Keep these concepts and common pitfalls in mind as you prepare for the CFP exam. Understanding Kiddie Tax rules and their applications will help you tackle these questions with confidence.